Hello, everyone, and good morning, good afternoon, and good evening to all of you. My name is Jonathan Dunn, and I'm the MC for this event. We would like to thank you for joining this IMF policy dialogue on climate-related financial risks and green finance. Please let me extend a special welcome to our distinguished speakers, moderators, and panelists who are making this event possible, and to the officials from Asia, the Pacific, and elsewhere who are with us today. Let me cover one housekeeping item for everyone joining the conference today and tomorrow. Please, you may leave your camera on at all times. Please remember, however, to mute yourself when you are not speaking as a moderator or panelist in your session, and to unmute yourself when you do speak in your session. Thank you. Without further ado, I would like to invite Kristalina Georgieva, Managing Director of the IMF, to make her welcome remarks. Ms. Georgieva, the floor is yours.
Thank you very much for putting us on track for an exciting event. And I want to join you by welcoming all who have chosen to spend their time in a dialogue on climate-related financial risks and green finance. It is a very important topic, and it is so critical that we zero in on the path to net zero. The science is clear. Only decisive action to contain climate change will prevent disastrous outcomes for people and economies. We must cut emissions globally by somewhere between 25 and 50% by 2030 to limit average global warming between 1.5 and 2 degrees Celsius. And we are not quite yet on track to do so. In the Asia-Pacific region, there is a significant attention, and rightly so. The region understands the urgency. Here, temperatures are rising twice as fast as the global average, risking more frequent and severe weather-related disasters. And the region produces about half of the global emissions and is home to 5 of the world's largest greenhouse gas emitters. What should we do? We must redirect resources to low carbon and energy efficient activities. And that requires a comprehensive package, including carbon pricing at adequate levels, proper disclosure of climate risks, offsetting measures to protect vulnerable populations, and green investments. On the latter point, we estimate the world needs energy-related investments at about $3.3 trillion per year until 2030 to achieve net zero by 2050. While this figure is large, it dwarfs in comparison with the broader benefits. Just from phasing out coal, they run into tens of trillions of dollars per year, as we show in a paper released today. All this underlines the importance of putting a price on carbon or putting in place equivalent measures to insensitize the transition and reap these benefits. Investing in adaptation is equally important. We estimate public adaptation costs of around 0.25% of global GDP per year in the next decades. But for some climate vulnerable countries, this figure could be as high as 20% of GDP. And while efforts at climate financing are increasing, it falls short of what is needed. We must urgently find ways to attract more climate financing, especially for emerging markets and developing economies. The role of markets and private sector critical to mobilize and efficiently allocate resources while putting a price on climate risks. And we see many issuers, including emerging market economies, starting to embrace funding via environmentally sustainable finance. The financial sector is playing increasingly an important enabling role. Of course, there are significant challenges, such as physical and transition risks. They must be managed well by central banks, by regulators, by financial firms, including by strengthening and harmonizing regulation, data, taxonomies, disclosures. But the biggest risk for us and for the world of finance is to miss the net zero path. The risk of market failure in climate finance underscores the important role for national authorities and international institutions like the IMF to provide and catalyze needed financing. This will have to be built as a strong partnership with the private sector and with financial markets. We at the fund are stepping up our work. Today, we are systemically significant institution in the fight against climate change, supporting our members through policy advice, through identifying financial stability risks, through capacity development, and through addressing data gaps. And on the lending side, I'm very grateful to our membership for supporting us to create the new Resilience and Sustainability Trust, already $40 billion strong, to help countries address structural challenges like climate change. And we are engaging with our partners, especially the Network for Greening the Financial System, as well as partners in the international financing community. Here, the chair of the Network for Greening of the Financial System is present, Ravi Menon, and I want to thank you and all your colleagues for your critical work. Let me finish with reminding us what Einstein once said. We cannot solve our problems with the same thinking we used when we created them. This is the aim of the forum, to put forward fresh thinking and exchange new ideas to address climate risks, grasp with the green opportunities presented to all of us. I wish you all the success in your work today, and I thank you.
Thank you, Ms. Georgieva. We greatly appreciate your welcome and remarks, which very nicely set the stage for this important policy dialogue. Next, I would like to invite Tobias Adrian, the IMF Financial Counselor, to make his opening remarks. Tobias, the floor is yours.
Climate change has become an utmost priority. While it has several dimensions, our focus today is on those aspects of climate change that could disrupt macroeconomic and financial stability. Recent global stress episodes remind us of the importance of crisis preparedness and resilience building. The COVID-19 crisis demonstrated how tail events can cause extensive disruptions of economic activity. The repercussions of the war in Ukraine have made evident the urgency to cut dependency on carbon-intensive energy and accelerate the transition to renewables. Tackling climate change is critical to ensuring a healthy planet, but also makes good economic sense. Studies have shown that the social gains far outweigh the costs of climate financing. There is now a sizable and growing body of literature providing quantitative estimates on the social cost of carbon. This measures the incremental harm from climate change caused by additional carbon emissions. And evidence now shows that avoiding emissions and moving to renewables would result in significant social benefits and an overall net gain for society. Potential risks to energy transition could amplify the financial system. Risks to energy transition could arise if the perception of the trade-off between energy security and transition changes rapidly, and net zero transition becomes costly, complex, and disorderly. Given Russia's large share in global commodity production beyond oil and gas, commodity prices, including those used as raw materials for renewables, such as aluminum, copper, and nickel, have risen sharply. The energy-related repercussions from the war in Ukraine may also alter the speed of phasing out fossil fuel subsidies in emerging markets and developing economies. A delayed or disorderly climate transition could magnify the risks to the financial system. Therefore, at the IMF, we have prioritized gaining a more holistic understanding of the implications of climate change for the global financial system and for financial stability. Let me lay out 7 areas of climate finance and stability that needs more vigorous attention by central banks and financial regulators. I hope these will help in the policy dialogue over the next 2 days. First, policymakers need advice on climate-related macro-financial policies. These policies have a crucial role to play because of 2 main factors. The first is the magnitude and global nature of the potential economic and financial stability risks. The second is the strong positive relationship between climate protection on the one hand and macroeconomic performance and financial stability on the other. Last year, we published a climate strategy that recognized a more systemic and strategic integration of climate change into IMF's activities. Growing demand from our member countries to assess macroeconomic and financial implications of climate change demonstrated the need to step up our climate-related work. Our bilateral and multilateral surveillance is giving more significant focus to climate-related issues, and we're increasing climate-related capacity development. Second, the urgency is needed for structural reforms to minimize the impact of climate change on the financial system. One of the reasons this has been stalled in developing markets is the lack of proper financing to effect structural changes. The IMF is stepping up the help to provide affordable financing to support countries in tackling structural challenges, including climate change. The new Resilience and Sustainability Trust that was just mentioned by the Managing Director, approved recently by the IMF Executive Board, will channel SDRs and address these macrocritical long-term challenges that pose significant macroeconomic risks to member countries. But more is needed. Third, central banks and financial regulators must systemically integrate climate assessments into their financial stability frameworks. When climate risks are deemed material and systemic, special attention will be needed to ensure the evaluation of how climate risks amplify and transmit risks to the financial sector. My 4th point relates to the regulation and supervision of climate-related financial risks. Preserving financial stability is the core mandate of financial supervisory authorities, who should therefore ensure that climate-related risks are adequately captured in the supervisory process. Where these risks are assessed as being material and likely to threaten financial stability, supervisors should then be able to intervene early. We are all learning by doing, but building capacity in this area is important. The 5th relates to central banks' mandates and balance sheets. Thanks to the NGFS, a lot of good technical work is coming out about, but again, more analytical work is required to assess the impact of climate change on central bank operations, governance frameworks, policy setting frameworks, and financial stability. We need to evaluate within the mandate of central banks how environmental sustainability objectives could influence central bank operations, the use of monetary policy tools, and to integrate sustainability considerations into central banks' balance sheets. 6, this is the issue relating to strengthening the climate information architecture. Assessing climate risks, allowing accurate market pricing, and enabling informed investment decisions require a robust information architecture around climate risks. The information architecture consists of 3 components: reliable, high-quality data, harmonized and consistent set of climate disclosure standards, and principles to align investments to sustainability goals. Implementing a global climate information architecture may also serve as the foundation to develop sustainable finance markets in emerging markets and developing economies. In this regard, current standard-setting bodies should fully take into consideration the difficulties in data collection in emerging markets, while ensuring that company-level disclosures are mainstreamed across the economies. We have Ravi Menon, Sarah Breeden, and Fabio Natallucci, who are taking forward via the NGFS the work on improving climate architecture. The 7th and final area that I will talk about this morning is the need of action to mobilize both public and private finance, while keeping the balance with other economic needs of countries. We need to understand the potential avenues to scale up private finance to mitigate climate risk, which is required to develop sustainable finance markets. Access to finance continues to be a barrier in many economies. In some economies, climate finance flows need to increase by 4 to 8 times until 2030, according to the latest estimates from the Intergovernmental Panel on Climate Change. Momentum is continuing to build on climate finance and other initiatives, but we need to act now to ensure the necessary frameworks are in place in years ahead. As the managing director mentioned in her welcome remarks, carbon pricing should be at the center of efforts to reduce emissions. Everyone must play a role in scaling up work and effort on climate-related financial stability and climate finance. Through this regional dialogue today, I sincerely hope that we will benefit from a frank exchange of challenges that countries face and what must be assigned as our collective immediate versus medium-term priorities. Thank you all, and the very best to this fascinating conference.
Thank you very much, Tobias, for your opening remarks. They provide very helpful background across a range of important topics that will be discussed during this policy dialogue. Let's now move on to today's Governor's Dialogue on Climate Risks. Our moderator for this session is Ms. Haslinda Amin, Chief International Correspondent for Southeast Asia and anchor at Bloomberg TV. I would like to give the floor to Ms. Amin.
Jonathan, thank you so much for that. Now, Kofi Annan, the former UN Secretary General, once quipped that Asia was a desert of responsible green financing. But fortunately, over the last 3 years, the region has made strides, and Bloomberg data suggests that Asia was the fastest growing region for ESG debt issuance in 2019. Never mind that it was from a very low base. A lot more work needs to be done getting to the scale needed, turning commitment to concrete climate action. And to that end, half of all Asia-Pac central banks have begun to integrate climate issues into their policy conduct. So what can policymakers, what can regulators do? What are the good practices? What should be the priorities? I'm privileged today to introduce Ravi Menon, Managing Director, Monetary Authority of Singapore, Nur Shamsia Muhammad Yunus, Governor of Bank Negara Malaysia, Maeva Atalina Emma Ainu Inaru, Governor of the Central Bank of Samoa, and Bowling, Deputy Managing Director of the IMF. So naturally, I will tap my Central Bank Governor, as you know, a very progressive Central Bank Governor. Ravi, you sounded a note of caution at COP26. You said climate change is a defining crisis of our time. And previously, you've also talked about how the worst is yet to come. A lot is at stake. We need bold moves on climate. So talk to us about what must central banks and regulators do to fight this climate crisis?
Yeah, thanks, Celinda. And also thanks to the IMF and Kristalina and Tobias. Good to see you all. And Lipo, at the IMF, thanks for bringing us together for this very interesting conference. I think the IMF MD had already mentioned this. We are currently not on track for net zero. If you look at it, the emissions are still rising. The use of coal is still rising right up to last year, right? And the numbers show that, you know, to get to net zero, this is the critical decade. By 2030, you need to bring down emissions substantially. We're already 1.1 degrees Celsius above pre-industrial levels, temperature increase. We've only got 0.4 degrees Celsius yet. We've used more than 90% of the carbon budget that we have since the pre-industrial era till net zero. So we are actually in a very, very challenging situation. Second, Asia is where the battle against climate change will be won or lost. Asia accounts for 45 to 50% of global greenhouse gas emissions. Asia also has the biggest challenge with respect to social and economic development. The trade-offs are much sharper. There are still large segments of Asia which do not have electricity. And I think this is a huge challenge of transition for Asia, that if we can get it right, we'll be on our way to net zero. Maybe in this first part, I'll focus on what the MAS is doing, because I do want to come back to what the NGFS is doing, which is, you know, as Tobias pointed out, trying to advance this work. And it's based on the conviction that central banks and regulators have a key role to play in the transition to net zero. Now, of course, there are things that are beyond central banks and regulators. Most important, carbon pricing needs to be in place, some form of carbon pricing. Second, we need emission standards. Price alone won't do the trick. We need some controls on emissions by industry. There has to be some kind of global accord on aviation, maritime, and so on. 3, technological advancements. Some of the technologies are still not at scale at commercial rates. So that needs to be addressed. And 4th is financing. And when you talk about finance, it is a concerted effort across the financial sector. And this is where central banks and regulators need to work closely with industry. So as I said, I'll touch on NGFS later, and maybe I'll just say a few words about what the MAS is doing in our Green Finance Action Plan. Actually, this applies to most regulators, depending on their mandates. First is to build the financial system's resilience to environmental risk. There's a huge risk coming up. We don't know when, we don't know the scale, but we know it's coming. And we need to prepare and make the financial system resilient. Second, central banks and regulators can have a role to play in ensuring that the market fundamentals are in place to support a sustainable finance ecosystem. So if you look at environmental risk, and this is one of the areas that many regulators, including MAS, are working hard on, environmental risk management guidelines, so that we've issued them. And it's important that we apply them across the financial sector, which means banks, insurance companies, asset managers, and capital market players. And it must be a consistent framework that applies to all financial players. Robust risk management, clear and relevant disclosure, effective governance and strategy. And this is something we're preparing the financial sector for. One of the things, second, is stress test, climate scenarios and stress tests. Tobias mentioned the NGFS climate scenarios. The IMF itself is beginning to use some of that in its Fsop work. I think climate stress tests are a wonderful way to focus the mind, because you don't know what's going to happen. There's no point trying to forecast. Imagine carbon prices go up to $200 globally. Imagine warming of this scale takes place in this geographic location, or sea levels rise by so much. What are you going to do as a financial institution? What does your portfolio look like? So we're now beginning to use the NGFS climate scenarios within MAS and in the financial sector. By the end of this year, we'll be actually able to do some very simple stress tests. And I think that focuses a mind on what the adjustments need to be. A second I mentioned an ecosystem. We need to build a market fundamentals for an ecosystem. And I'll very quickly mention 3 things that are critical: data, definitions, disclosure. The 3 Ds, right? If you don't have good data, nothing happens. You need to know what the carbon emission footprint is. You need to know what the success of abatement measures are, right? And you need good data for that. And getting this high quality climate related data is a huge difficulty. We talk to many financial institutions. This is not easy. We think technology has the potential to solve this problem. Satellite imaging, IoT devices, API connections, many different ways in which you can extract data at source so that you can measure this. We call it green fintech, riding on the fintech phenomenon to advance the sustainability agenda. Second, definitions. These are very important. Taxonomies. We need globally interoperable taxonomies. Taxonomies are particularly important in Asia. And we're working with our ASEAN neighbors, and Noor Shamsia is here, trying to develop a transition taxonomy for Asia. We know what is green, we know what is brown, but getting from green to brown is a journey. It is a transition process, and we need clarity about what is allowable, what is credible transition. And this is very important for Asia, which is still in the throes of development and urbanization and giving their people a better life. So taxonomies are important. Third is reporting, disclosure. And here we're very excited by the work that's coming out of the ISSB. For the first time, we have a decent shot at a global reporting standard for sustainability, and securities regulators around the world, including the MAS, we are insisting that these become mandatory. This goes beyond TCFD, and this will make comparability of risk assessments due to climate risk much more easier. So I think when your disclosure, again, there's market discipline, there's pressure to perform, and you can't run away, and you will do the right thing. So maybe I'll stop there in terms of what we are trying to do. Environmental risk management, that is key. And second, building the ecosystem of data, definitions, and disclosure. Thank you.
Ravi, I'll pick it up from there. And Governor Noor Shamsia, you said that climate change presents a major economic issue. It has direct implications of financial stability. Talk to us about the most important challenges there.
Thank you, Haslinda, and I would like to thank the IMF for inviting me to this very important conference for us to share our thoughts and our journey so far. So for Bank Negara, our journey began well before the pandemic, and because we have been seeing the growing impact of weather-related events on our economy and financial sector, we had droughts, floods, the haze, to name a few. So as a bank-based economy, more than 70% of total financing to the private sector in Malaysia is in the form of bank financing. And nearly half of the bank financing to businesses are to SMEs. So it is obvious that banks have a crucial role in supporting an orderly green transition. So banks play an important role in enabling their clients and businesses to adapt, and banks can accelerate the transition through their lending, underwriting, and investment decisions. So as climate-related risks are unique, our climate strategies for the financial sector have been guided by 2 key considerations. Firstly, the need to build capacity and retain the ability to adapt our framework and approaches as we learn more about climate risk drivers and their transmission channels. And secondly, the importance of ensuring the financial sector's response to climate risk is aligned with internal strategies and framework, and as well as policies and developments in order to minimize social and economic dislocations. So with this in mind, we focus on laying a solid foundation and, what Ravi said, the ecosystem for climate risk management and transition. So there is a need to create awareness, firstly, and build relevant expertise within the financial sector around climate change. And this starts right at the top with the captains and leaders in the financial sector and ourselves to drive home the climate urgency. Secondly, we established the Joint Committee on Climate Change, or JC3, together with the Securities Commission, Malaysia, as a regulated industry platform to coordinate, drive, and support an industry-wide response to climate risk. And thirdly, we develop and roll a principle-based taxonomy as a common classification system for economic activities that are climate compatible to guide investment, financing, and underwriting decisions. So moving ahead, we will continue to strengthen our regulatory expectations, and this will include, like what Ravi said, enforcing mandatory disclosures, stress testing, and also to review our prudential standards where appropriate. We will also be focusing on finding solutions to address some of the challenges that we face as an emerging economy. Let me cite as an example the spillover risks caused by the war in Ukraine and the ongoing uncoupling of the Russian economy from the global economy. So this will include upside risk to inflation from higher commodity prices and supply chain disruptions. So such risks have led fears that commitments to climate action could be set back. At the same time, the war has also brought forward the reality of a disorderly transition. Another challenge is the risk from transition spillovers. Coherent national policies are crucial to address the environmental and socio-economic challenges that emerging economies face in competing for desperately scarce resources. And these policies cannot be pursued in isolation, and it has to take into account the effects of transition spillovers from the growing international momentum towards net zero. But despite the challenges, this is also the time for financial institutions, business owners, and investors to become part of the solution and embrace climate-aligned actions. This is not only the right thing to do, but also a smart economic move. So I also want to underscore the critical role of the international community in ensuring that climate finance, technology, and talent flow to EMDEs to achieve an equitable and just transition. Our energy sector, for example, requires about 250 billion worth of investments to transition to net zero by 2050. So international financial institutions can and must support this through the significant influence that they have through their surveillance and advisory functions, technical assistance, and financial resources. This is happening, and it will be critical to sustain and further intensify these efforts going forward.
It's challenging not just for emerging markets, but also for island states, particularly at risk to climate change on the front lines as sea levels rise. Governor Ainu Inaru, you're on the front line. Samoa, 70% of its population are in low-lying coastal areas. What does climate change mean for a small island nation? How are you assessing the economic and the financial impact?
Thank you, Haslinda. Good morning to everyone, fellow governors. It's it's 1 a.m., so excuse the. So as a small island nation in the middle of the Pacific Ocean, we're very vulnerable to natural disasters, as you are well aware. Like you said, 70% of Samoa's population and infrastructure are located in low-lying coastal areas. So climate change is already affecting all economic sectors in the country and may cause more frequent and extreme rainfall, longer droughts, sea level rises, increasing acidification of our waters as global warming takes its toll on the Pacific Ocean. And in 2019, we experienced unusual king tides and more extreme rainfall in months that would normally be considered as our dry months. So these climatic conditions are expected to continue and worsen. Economic growth and development now would be impossible unless we ensure that every investment, whether it's infrastructure, food security, watershed management, health improvements, tourism, takes into account the latest climate change projections and their expected impacts. For information, Samoa has had its fair share of fatal and insignificant natural disasters, with destructive major cyclones in 1990, 91, 2004, and 2012. And we also had a tsunami in 2009 that killed 149 people. And the most recent major cyclone in 2018 also resulted in devastating floods that caused infrastructural damages in the capital. So when affected by climate change through catastrophic natural disasters, the cost of damages is at a minimum at least 30% of GDP. Now that's a substantial cost to bear for a small island development state like Samoa, where GDP growth was around 3 to 4% per annum. This is pre-COVID levels. So the impact on the financial sector following any major adverse climatic event is similarly significant, as credit risks for affected businesses or individuals unfortunately rises, providing limited access to finance for their recovery or to return to normal operations after a disaster. The insurance sector would also be particularly exposed as climate change or weather-related insurance losses mounts on the back of more frequent and intense natural hazards. So there is potential that climate change will pose a major risk on the financial system in the long run. In Samoa, developments for climate change had mostly focused on and concentrated on adaptation development measures. Mitigation development measures need more financing through research and development for clean and efficient energy projects and programs, greener environment, as well as a blue ocean. So accessing finance and to be more mainstreamed and streamlined in the processes and procedures for such national developments will assist with economic activities in Samoa, and I'm sure in other Pacific small island development states. So it is about how best we can use our limited resources to build back better and stronger from any significant climatic events that we face. Thank you.
Governor Anuinaru, I mean, we give you 3 gold stars for being with us at 1 a.m. We really appreciate you being here. Deputy Managing Director Lee, the IMF helps countries adapt and build resilience to climate change. What aspects of climate finance does the IMF work on? How is the IMF helping its members to address the financial and economic threat from climate change?
Thank you, Haslinda. Good morning and good evening. Well, financial sector is both at the receiving end of climate shock and at the supporting end of the climate transition. So financial sectors are heavily impacted, but also could play a crucial role in helping our members managing the green transition. As Managing Director Kristalina mentioned, IMF has become a systemically important IFI in the field of climate change. And in relation to financial aspect of climate change, we are doing many things now, and we are helping our members in several, we think, key areas, or I can call them 3 buckets of work relating to the financial aspect of climate change. The first bucket would be the foundational work. The second bucket is financial stability related work. And the third bucket is in terms of mobilizing public and private financing to support green transition. Let me go through this bucket quickly, one by one. The first one, the foundational work. As both Kristalina and Tobias mentioned, that we think carbon pricing is at the core of proper green transition, both in terms of helping financial sector to manage the transition and physical risk, but also in terms of providing the proper price signal to the market in terms of mobilizing public and private investment. So carbon pricing is the core of our work. In addition to that, as Managing Director Ravi Menon mentioned, that we need the information architecture. We need the definition, we need the data, and we need disclosure. And thirdly, we need a lot of international cooperation. It's a global challenge. We need global solutions. So we're working closely with G7, G20, FSB, NGFS, and other international standard setters in this climate finance area. In terms of the second bucket, which is financial stability related work, as previous speakers have emphasized, financial sector could be severely impacted by climate change going forward. So we have incorporated climate change into our flagship program, which is called Fsop, Financial Sector Assessment Program. We try to help our member countries to identify the key pressure points in their financial system in face of climate change. For example, in the UK Fsop that we just completed, we try to assess adequacy of prudential regulation in face of expected policy changes to respond to climate challenge. We're also experimenting climate stress testing. We're also advising our members to adapt their regulatory and supervisory framework to handle climate risk. And we are also doing capacity development to help our members to manage their debt in face of climate challenge. So that's the second bucket. But the last bucket of work, which relates to mobilizing public and private financing to support green transition, and we call sometimes we call them green finance. And as Ravi is chairing this NGFS, we are working together to build the information architecture, but at the same time to find ways to mobilize public and private capital. For example, we newly established a new trust, Resilience and the Sustainability Trust, RST, and we try to use this new trust to mobilize excess SDR holdings by our members to support long-term initiatives in our member country to fight challenges such as climate change. And we have received commitment of more than $40 billion so far, and it's still, we are receiving more, on the way to receive more. In addition to that, we are also thinking hard, working with our partners in terms of public-private partnership. How can we mobilize more private capital with large scale to support green transition, especially in emerging markets and developing countries? And there is a huge financing gap in these countries in the next 10 to 30 years. I think that the focus here is how to correct the market failure in the private financing market for climate projects. For example, there is obviously there is a shortage of equity capital in climate projects, and a lot of EMDs already have a lot of debt, and their capacity to absorb more debt is very limited. So how can we, together with private sector, to provide equity capital to climate projects in EMDs? I think it's a challenge that international community should work together to try to solve. I stop here. Thank you.
On financing, it is key, and we heard from Kristalina earlier about how adapting to climate could cost a country as much as 20% of its GDP. Governor Adrinari, I'm just wondering, has there been enough support for island nations, developing countries, to stem, I guess, to counter climate challenges?
Thank you. Well, we acknowledge the availability of substantial and continuous support for island nations and developing countries from our key development partners. We note that multilateral financial institutions such as the World Bank and Asia Development Bank have already mainstreamed climate change into their development projects and programs. The IMF also provides support through the Climate Macroeconomic Assessment Program, CMAP, and we did that for Samoa last year. For Samoa and perhaps the most Pacific small island development states, the major issues are firstly, it is accessing the technical capacities and capabilities to design and stitch together a sound and practical proposal for small island development states that lack such development privileges. Secondly, it is the effective coordination of climate change developments for Pacific small island development states to ensure that development partners' requirements are streamlined. And thirdly, it is the efficient implementation of climate resilient developments to ensure that resources are effective and fully utilized as per proposal. At an institutional level for the banking sector in Samoa, especially those of local ownership, there is indeed a strong acknowledgement and support for the sustainable or green finance initiatives. However, the additional challenges remain, such as a limited awareness of technical capacity of commercial bank staff to assess climate risks on any investment proposal. There is a perceived high risk associated with some projects, such as renewable energy, production of biodegradable products, waste treatment projects, and so forth. There's also the increasing vulnerabilities of SIDS to more frequent natural disasters, which heightens the credit risk of a country and to some extent access to climate finance. And there's that influx of opportunists, con artists claiming to be financiers and riding on the global climate change agenda. So in view of that, strong collaborations between the government, private sector, and all other members of the community is critical. And part of this includes the need to build or enhance the capacity and knowledge of all players in the financial system on climate-related risks, as well implement sustainable finance policies into practical investments in green and inclusive projects that are consistent with national environmental priorities. Necessary capacity building and financial support to help financial institutions and the private sector, especially the SMEs, the small and medium-sized enterprises, to adapt to new expectations on the climate change front, and that is important. So in fact, since Samoa enforced a ban on single-use plastics in 2019 to address the growing issue of plastic pollution, there has been a wide general support by our people, with some even reverting back to the use of baskets woven from coconut leaves for their shopping. So it's also seen the establishment of a private company that produces biodegradable plates and spoons and forks from dried palm leaves. So the opportunities are endless with Samoan ingenuity. I'll stop there.
Thank you. We certainly want to put a stop to those con artists, Governor. Ravi, the MAS wants to develop Singapore into a leading center for green finance. How can the public sector support the greening of the private sector? We often talk about, tapping the private sector. In this case, how can the public sector support the greening of the private sector?
Yeah, no, thanks, Linda. That's a good question. And I'll speak more broadly than just what the MAS is doing, because I think you've put the finger on the key issue here. And Maiva has also mentioned that, Governor Maiva mentioned that too, that to get the amount of financing that's required, and you look at what is happening now, there's a huge financing gap. Lipo mentioned that. There's a huge financing gap. I mean, there are lots of estimates. You look at a study by Boston Consulting Group, the amount of climate financing that needs to grow over the next 3 decades is roughly 5 to 8 times the current amounts raised. And if you look at the International Energy Agency estimates, the global investments in energy projects needs to more than double from current levels by 2030. That's just 8 years away in order to meet net zero goals. So investments in renewables are not occurring in the scale that's required. Now, there are many parts to this ecosystem, and we need to solve this problem in a concerted fashion. The banks are the ones who can originate most of these loans, but bank balance sheets are constrained. The risk-return trade-off is just not there. So many bankable projects, especially in Asia, are getting green financing. But the vast number of projects that need to happen are just below the bankability threshold. And the risk is just too much for the banks to take. Now, there are a lot of institutional funds who are keen to be invested. Institutional investors, philanthropic capital, they all have an increasingly ESG agenda, but they need to find instruments. They can't invest in a, in a windmill or a solar panel plant. That's too big and lumpy a risk. They need to find instruments, securities that represent that green ESG dimension and flavor. So you need a solution that will take away that equity, that will take away that first loss risk. And this is an important point that Lipo made earlier. What you don't have is equity risk, equity financing to take first loss risk, which will then crowd in private capital. So the public sector, and by the public sector, I mean national governments and the multilateral development banks, their role, rather than to directly finance these projects, which is just not going to cut it because it's not enough. No country has the fiscal resources. The MDB's balance sheets put together is not enough to meet the scale of financing required. So the best thing they can do is to take just equity risk that will then crowd in many more times of private capital, because once they know equity risk is taken care of, first loss risk, there's some risk sharing, private capital can come in a lot more in a much bigger way. And then the banks need to recycle that capital to the institutional funds, to capital markets, which are the deepest and broadest source of capital today in the world. So you need to bring banking systems, philanthropic capital, institutional funds, capital markets, national governments, and multilateral development banks in a co-joined financing ecosystem. Because if you put that together, there is enough. There really is enough. You can meet all these numbers that I just mentioned, but we need to get cracking at this problem. And to crowd in private capital, public capital needs to step in a very targeted and calibrated fashion, rather than to finance everything out of their own balance sheet. Thanks.
Just to follow up, you see there is enough. I mean, Mark Carney says 450 institutions have committed $130 trillion in assets being directed to net zero. So what you're saying is we are where we need to be in terms of the commitment already?
But in order for the commitments to flow, they still need to meet a risk-return hurdle, right? That's what I said. Institutional funds, asset managers want to get into the space. They are making commitments, but they cannot actualize their commitments because they cannot get a return that is commensurate with the risk. And many of these projects are still not bankable. They're just below the line. And to tip them over, you need some kind of public credit wrap.
DMD Lee, the IMF has identified climate change as a major threat to economic prosperity and financial stability. What efforts are underway at the IMF to identify and measure these risks? Can you give us some concrete examples?
Thank you. In our, again, in our flagship financial sector assessment program, Fsop, we assess 2 types of climate risk to the financial sector. One is physical risk. The other is transition risk. So let me start by saying that we have completed a number of country cases in terms of Fsop and incorporating climate change, climate risk into Fsop assessment. These countries including the Philippines, Colombia, Norway, the UK, United Kingdom, and South Africa. So let me go through these two types of risk one by one. In terms of a climate physical risk, we are doing this primarily for economies where physical risks are material, such as the island countries, as Governor Maiva represents here. For these countries, extreme weather events are becoming more frequent and more intense, which could also be signaling longer-term shifts in climate patterns. And for these countries, climate change events could cause significant damages to physical assets, to financial market, and to productivity. And these changes, this impact could in turn affect the resilience and stability of the financial system. Let me give you an example. In the Philippines, Fsop, we focused on the impact of typhoons, and we find that the typhoon could cause a material impact to financial stability in certain scenarios. And the second type of risk is climate transition risk. And in this category, we try to assess the impact of policy change, policy reactions to climate change on the economy and on the financial system. For example, in the UK Fsop, we assess the impact of pricing in upfront the change in companies' prospects on asset valuations, which could materially change the asset quality of financial institutions today. So depending on the scenario and the extent of exposure to carbon in different sectors, climate transition risk could be material, even in the near term. That is because long-term climate change could result in asset price fluctuations now if significant policy changes are expected to combat such climate change. I stop here. Thank you.
Earlier, we heard Robbie talked about the ecosystems, the 3Ds, data, definition, disclosure. There is a massive data gap. I mean, it is hard to collect. It is expensive. It's not transparent. Governor Nursia, we know that you've identified at Bank Negara better climate data disclosures and so on and so forth. What are some of the concrete steps you're taking? And where do you see the biggest challenges as well as the biggest gaps?
Thanks, Linda, for that question. Yes, we see these three areas as key components of the building blocks for the financial sector to catalyze the economic transition. So on taxonomy, we were among the first to advocate a principle-based taxonomy. This approach we took to support an orderly transition by recognizing the different starting points of the various economic agents. It also creates appropriate incentives as well as secures the support needed from financial institutions to begin the transition journey in a pragmatic way. So the taxonomy recognizes remediation measures and acknowledges concrete efforts and commitments by businesses to adopt sustainable practices. So for us, this nurturing approach is important to avoid disruptive exclusions and dislocations and ensure an orderly transition. So we are now directing efforts towards the effective implementation of the taxonomy, its integration into financial institutions' business strategy, as well as risk management frameworks and practices. This is crucial to avoid any risk of greenwashing. So I am glad to say that a similar approach has also been taken for ASEAN. In a record 7 months, we have released version 1 of the ASEAN Taxonomy for Sustainable Finance. The ASEAN Taxonomy was developed in recognition of the need to have a common language within the region, given the significant and growing intra-regional trade within ASEAN. While we recognize the importance of having a credible taxonomy, It is equally important to have a taxonomy that is inclusive to reflect ASEAN's diverse economic and social structures and to ensure an orderly and just transition. And the ASEAN taxonomy strives to achieve this through its dual structure, comprising the foundation framework, which is a principle base to guide ASEAN member states that are in the early stages of the climate journey, while the plus standard incorporates metrics and thresholds for countries that are more advanced. The foundation framework led by Bank Negara Malaysia will be finalized this year, and work is ongoing to ensure the timely issuance of the plus standards with thresholds for identified focus sectors. So Ravi, you probably have more to say on the plus standard, which is being spearheaded by MAS. And we remain committed, fully committed to working with you towards issuing subsequent version to sustain the momentum towards regional climate ambitions. So on disclosure, we will require our financial institutions to make mandatory disclosure which are aligned with the CFD's recommendations beginning from 2024. And in support of this, the JC3 has released a guide on how to apply it for industry feedback. So as disclosure for financial institutions will depend on access, like what all the other speakers have said, to credible information on their customers, the JC3 has also commenced work to develop a climate disclosure guide for Malaysian businesses. So on climate data, our JC3 has been working to identify data gaps and find ways to bridge them. What we learned is that only 21% of the identified data are readily available. So that clearly there is more to be done here, and we are now working very hard to finalize a data catalog on the immediate data needs for the financial sector.
And Ravi, earlier we talked about how you were appointed as the chair of the Network for Greening the Financial System, NGFS, 114 central banks and supervisors that you oversee in a way. I mean, if you take a look at the next year, the next 12 months, what would be your priorities?
Yeah, thanks, Aslinda. We are a network, a very loose, informal network, which has allowed us to move quite quickly and nimbly and in an agile fashion to address some of these issues. Because we're not, we have a very small setup and secretariat out of the Banque de France and a very active steering committee. And it's the members themselves that do most of the work. It's a hugely collaborative effort. And so looking ahead, we want to remain ambitious in our aim to green the financial system. And we're going to be embarking on a new work program this year. And I think a key dimension of this is to basically move from climate awareness, which is something we've built up over the last 4 years. And almost every central bank and regulator in the world is now committed to this. We have 114 members. That's a very large percentage. But to move from awareness to action, what are the concrete things we're going to do? So we've launched 6 initiatives. 1, to enhance supervisory practices with respect to managing climate risk. 2, to design actionable climate scenarios, which I mentioned earlier. 3, to assess the implications of climate change for monetary policy. Now, this is a new area. 4, to provide guidance for central banks on their own net zero transition so that they can lead by example. 5th, another new area, which I think has not gotten enough attention, which is to analyze nature-related financial risks as distinct from climate risks. And last, to build capacity. Governor Shamsi has mentioned this. This is absolutely critical to build capacity among our members. So in the area of supervision, you're paying close attention to the role that we have to examine financial institutions' transition plans. So stress test is one thing. The second step is, what is your transition plan? Many financial institutions, as you pointed out, made commitments to net zero and investments. How are you going to transition? What is your plan? So we want to see if these plans are resilient to environmental risk. We want to see what are the good practices that some supervisors have in overseeing these transition plans. And we also want to see how should financial institutions oversee or, in a sense, have sight of their counterparties' transition plans, because we're all connected. See, my transition plan depends on your transition plan, whom I lend to, whom I invest in, whom I insure. So we need to have that nexus too. Climate scenarios, the NGFS scenarios are widely used. We now need to enhance them further. We want to strengthen the physical risk modeling, both for acute physical risk and for chronic physical risk. And one of the feedback we get is we need to increase the granularity, the sectoral granularity of the scenarios and the geographical coverage. So we'll pay particular attention to emerging and developing economies in this next round of enhancements to the scenarios. The third, as I said, monetary policy. This is a new area. So we're going to see how climate change should be considered in the conduct of monetary policy. Focus on macroeconomic modeling of both critical transition risks and emerging risks so that they can analyze the impact on the economy. We're also looking at what kind of climate-related adjustments can central banks implement to ensure the smooth conduct of monetary policy operations, and whether the central bank's monetary policy operations themselves could potentially support the transition to net zero. So this is an entirely new area, exploratory. Fourth, net zero for central banks. Many central banks are also earnest about making themselves green. If you want to make the financial sector green, you got to green yourself first. So we're going to be looking at for past work done in this area. What are the suitable metrics? How can central banks disclose climate-related and environmental risks? And how do they manage their internal operations and see how they can be greened? Nature-related risks, that's the fifth area we're looking at. We want to mainstream the consideration of nature-related financial risks. The natural ecosystems determine a great deal about the kind of air, water supply, or food supply. And we imperil these natural ecosystems through our actions. So this is a separate environmental risk that is distinct from climate risk itself. And we need to understand this more. So we're going to try to make these nature-related risks more tractable, focus on those with a nexus to financial risks, and see how this can be integrated into the other streams of our work. And actually, we want to look at a few local case studies to work through concrete examples where the link from the degradation of the ecosystem to climate change is clear. Take, for instance, deforestation. So that's something we want to get a deeper handle on. And last, capacity building and training. So we want to go beyond just organizing training programs, but to build a training and capacity building strategy that central banks and regulators can apply in-house to build up their skill sets, and a training curriculum to again help central bankers build up their capabilities in a progressive manner, foundational knowledge, more advanced and specific skill sets. And I'm very happy to note that Bank Negara Malaysia is co-chairing this effort with the Bank for International Settlements. And it will have a particular focus on how we can scale up capacity building in the emerging economies, which are really key to solving this problem. So those are the broad 6 areas. And a key hallmark of the way we work will continue to be inclusivity, garnering and mobilizing the resources of advanced economies, emerging economies, and developing economies, and working very closely with international financial institutions like the IMF, or a very close partner, also with the standard setting bodies, and also with the financial industry. I think that can't be emphasized enough. Thanks, I'll stop here.
So it's going to be a very busy year for the NGFS. Just in conclusion, and as we look ahead, Governor Ainu Inari, perhaps you can share your top priority for climate finance.
Thank you, Haslinda.
Timor-Leste is among the...
Governor Ainu Inari?
Yeah, I thought I just got dropped off there.
Just briefly, the priority for climate change in the year ahead for you.
The 3 priorities for climate, climate finance. Firstly, the practical design of proposal of climate change development priorities that suit the absorptive capacities and capabilities of small island states like Samoa. Secondly, the effective coordination of climate change developments through mainstreaming and streamlining the different key requirements and standardizing terminologies, particularly those of development partners. And to this extent, development partner coordination is also very critical. And thirdly, the efficient implementation of climate change developments to enhance the utilization of resources provided by development partners. And for the central bank, more work is needed to provide the appropriate capacity building opportunities for the staff and those of the financial institutions on all aspects of climate change, particularly climate risk assessments for potential green investment projects from the private sector and the community in general. And secondly, to identify and address current data gaps through appropriate data collection requirements on climate change developments through the lending of commercial banks to the private sector and community in general. For international financial organizations to ensure that there is clear demarcation of resources from development partners that actually reach these developing countries, either through budget support or using the financial system of that country. So all in all, for us to have a meaningful and effective contribution to address climate change, I believe strong partnerships and collaboration is critical between the public and private sectors, among central banks and financial institutions, with the international financial organizations and partners at the regional and global level. So yeah, the time is now for all of us to act.
Indeed. Governor Shamsia, your priorities.
As a supervisor, my first priority would be to require the financial institutions to urgently up their game in the management of climate-related risks. So this would mean improving its ability and capability to identify risk exposure, preparing to de-risk where needed and in an orderly manner, and helping their customers to transition. So the financial sector is well placed to do this role, given its important intermediary function in the economy. Second, like what Libo have said, and even Ravi, we need to better mobilize private capital and technology, including relevant infrastructure to finance climate actions. So, like what Ravi had said, we need to go beyond traditional finance and explore more innovative financing mechanisms, such as blended mechanisms, alternative finance, and impact and value-based investments. Protection and risk mitigation solution must also cater to climate risk. So this would be central, critical to scale up the kinds of solutions we need to transition. Third, capacity building and awareness. We can only achieve a smooth transition to a low carbon economy if everyone is on board. Not only the financial sector and government, but also businesses and households. All of us need to understand climate risks and embrace practices that are climate friendly. So on your question, Haslinda, on what central bankers, regulators, and international organizations can do, again, I would echo what my colleagues have said. Collaboration remains key, especially in supporting the financing of climate innovations.
Final words, Deputy Andy Bowley.
Thank you. I think the key challenge for central banks and regulators, supervisors around the world is that how to mobilize private capital in large scale to support climate projects, in particular in emerging markets and developing countries. So to tackle this challenge, we think three things are very important. The first thing, as I said, is carbon pricing. We need to move the carbon price towards the $75 per ton by 2030 if we want to send the proper pricing signal to the market. The second thing is the information architecture, as NGFS has done, which we think is very important, data, disclosure, and definition. And the last priority is to figure out how to promote public-private partnership. In particular, how public sector can step up in providing the much needed equity capital to crowd in private capital so that we can achieve climate investment in large scale to try to tackle this existential challenge of mankind. I stop here. Thank you.
With that, I'd like to thank Deputy MD Bo Lee, Governor Anu Inari, Governor Nur Shamsia, and MD Ravi Menon for your valuable insights. It was a great discussion. Thank you for your time. And now let's take a look at the perspectives from small island and vulnerable low and mid-income countries.
Timor-Leste is among the least well-equipped countries to adapt to the increasingly rapid effects of climate change.
In 2021, Tropical Cyclone Soroja hit Southeast Asia, killing hundreds and causing an estimated $500 million in damages.
It happened during the night that a lot of people were not prepared. People, when they wake up, suddenly they were already underwater, the beds were already underwater. Although the rain was just 24 hours, a lot of them, livestock were killed, their farms were destroyed, and they were not able even to harvest their produce.
For island nations, every storm that blows in and each centimeter of rising water is a costly setback, not just in Timor-Leste, but in other island nations, such as Micronesia.
Climate change poses tremendous challenges for Micronesia. These include sea level rise and severe natural disasters, such as storms, floods, and droughts. The warming ocean is also harmful for our marine resources, our main revenue source.
The IMF is doing its part to help island nations build resilience through climate macroeconomic assessments, financial risks identification, policy advice, and technical assistance, including through our Pacific Financial Technical Assistance Center. The costs of adapting to climate change for these low-lying countries are substantial. For some developing island countries, it can be a big part of annual GDP, so large amounts of financing are needed. Developed economies have already promised $100 billion per year in climate financing to vulnerable countries. But flows have fallen short of that target, and much more is needed. The IMF will also be making longer-term financing available through its new Resilience and Sustainability Trust. Long-term institutional investors can help too. This requires the development of green finance to help reallocate investment to green sectors. In the Pacific, Fiji has benefited from green bond issuance to mobilize finance for climate resilience development. And while challenges for small island nations are primarily in adapting to climate change, they can also play a role in climate mitigation.
We have mandated our Sovereign Wealth Fund to seek investment opportunities associated with the global transition to a lower carbon economy and banning investments in assets associated with high carbon emitting companies. We call on sovereign wealth funds and global fund investors to follow the same path, to shift investment capital towards green investments aiming to protect the planet.
Addressing the climate challenge requires all of us to act now, to build the financial partnerships that build resilience today and saves lives tomorrow.
Natural disasters and climate change is becoming very real to us. It's something very real here and now.
So a huge thank you to Haslinda Amin and to each of the panelists, and also to all of the people who produced the video that we just watched. The session that we just had did an outstanding job of covering progress, challenges, and key issues in the area of climate-related risk and finance. Thank you to everyone for joining us today for this public session. The closed-door dialogue among policymakers will start at 9 a.m. Washington time, so in approximately 8 minutes after a short break. For those who will join the closed-door dialogue sessions today, please be sure to use the sign-in link shared with you by the conference organizers. Thank you.